Welcome to Spotlight Television. I'm Damon Roberts. Judson Gee is the managing partner of JHG Financial. He's a top financial advisor who specializes in tax mitigation. For almost 30 years, Judson's strategies have helped pre-retirees, retirees, and business owners safeguard their wealth and minimize the amount of taxes owed at tax time. His comprehensive wealth management and investment advice, along with his impressive range of skills, has made him a leader in the field. Renowned for his expertise in creative tax mitigation strategies, we're honored to have him in studio with us today. Please welcome Judson Gee to Spotlight Television. Judson, welcome.
Thanks, Damon. Appreciate you having me up here to New York City.
Yeah, it's great to have you here. I mean, obviously, it's such an important topic we'll get into, tax mitigation strategies. But you have a fascinating story. We talked a little bit off camera about how you got into the business, a little bit about your background. So why don't you tell the audience a little bit about yourself and how you got into this?
Yeah, thank you so much. Well, you know, I'm from Charlotte, North Carolina, and I got into the business of very interesting, kind of two stories, really. One is my mother passed away at a young age, and my grandmother had a lot to do with my upbringing. And I'll never forget it. She brought her CPA down into Charlotte from Greensboro and sat down at all NASCAR hangout, and being a good CPA, Taylor said, "Judge, you're a lucky young man. You could be a millionaire by the time you turn 30. My grandmother stopped him right there and said, "Hey, you know, I hope he's right. I hope Jefferson splits as many times over your lifetime as it has over ours. There's two things, Judge, you got to promise me. One, I want you to tithe. I want you to give back." And Taylor, of course, broke in like a good CPA and said, "Yeah, we contribute highly appreciated stock, and you get a deduction from that, Judd." My grandmother kind of rolled her eyes and said, "Hey, I hope Taylor's right. It's going to be easy for you to cut a check. But the second thing I want you to do, Judge, is actually roll your sleeves up and go out there and build a house for Habitat. Go to the soup kitchen. Look into the eyes of those that you're going to help. And that's going to come back to you tenfold. Best advice I ever got." And the second part of that story was in my senior year, I took a communications class, and the last project that we were asked to do was kind of sell the class on something. Well, I had been in a motorcycle accident, got some money from it, and my dad's stockbroker said I should invest it into tax-free municipal bonds. And so I gave a speech on that. The president of the class came up and said, "Judd, I'm a poor college kid, but if I'd had some money, I'd put some money into that. Have you ever thought about being a stockbroker?" Because that's what they called us back then. Light bulb, and decided to get into that industry. So, you know, it seems like it was almost coursing through my veins, tax mitigation, the whole time.
Yeah, that's a great story. So let's talk a little bit about what you are and what you aren't. You are a CPA. Explain to the people exactly what you are and what advice you can and cannot give.
Sure. I'm a federally registered representative, so I have a Series 7. Also, I'm a fiduciary of a Series 65, which allows me to do fee-based business. I also have one of the highest designations in our industry, which is a Series 24. And so my compliance department wants to make sure that I let your audience know I am not a CPA, nor am I an attorney. We work really closely with them, but I cannot give tax advice or legal advice.
Yeah, and the importance of that overall team as what you do as opposed to what they do and bringing them together. Talk about kind of like how important it is for not just what we're going to talk about today in your strategies, but making sure you have all of those different components working together for the most successful outcome.
Absolutely. You know, it's really a trifecta with the client in the middle, of course, the most important. And I think, you know, it's sad to say again that a lot of financial advisors are not working as closely with that CPA and that estate planning attorney. I'm also a certified estate planner as well. Again, doesn't allow me to give legal advice. But, you know, when you've got a great team like that, really working in unison, it can really put a lot of go-go juice into your plan. So I advise folks to make sure that those two or three are speaking and having a great fluid relationship like we do with our teams.
Yeah, and make sure the people who are doing those individual components are actually professionals in that. The guy who's Uncle Joe has been doing your taxes for 15 years may not be the right guy if you're trying to exit your business.
Yeah, if you're getting ready to sell your business for $30 million or $5 million, or you bought some real estate, some rental properties, and those have gone from $500,000 to $2 million, you got to have the right people, because when you're filing for doing intangible drilling costs like oil and gas, or you're doing an opportunity zone, or you're doing discounted Roth conversions, you want to make sure that that particular tax expert knows what the form numbers are, where to put it. We've seen that a lot of times when clients are doing these strategies with me, but they're not using my CPA. Luckily, he said, Judd, not only will I run a tax planner for them to show them almost to the penny what they're going to save, but I'd really like to see a copy of their 1040 just to make sure that the other CPA's putting everything in the right place. You know, so it's definitely key to have those working together in unison, very fluid.
So let's talk more about the industry and what you guys do. Is there something that, you guys think of yourself as kind of, this is what we specialize in, this is what separates us from other people who might be doing a fine job as well, but kind of separates you from others?
Absolutely. I think it's communication. I mean, tax mitigation is definitely being missed, I think, by a lot of financial advisors, especially on the investment vehicle side. But the number one thing I hear, Damon, when someone comes into my office, and let's say they've worked with another financial advisor, I like to ask them, why would you come to my office? You've already got a current advisor. And the number one thing that they say is, I never hear from him or her. Or if I try to get in touch with him or her, it's tough to do. So as I mentioned, my cell phone is on my card. I prefer my clients to call me 24/7. I will pick up that phone unless it's past, say, 10 p.m., but I will let them know that I'll get right back to them. And also, one of the things that I started an initiative back in the early 2000s, I call it a pre-designated conference call. So the last thing that we do when we onboard clients is we say, hey, Damon, how often would you like to speak with me? Most clients, that's probably 2 to 4 times a year. But we can't generally meet anymore. The days of Zoom after COVID, that's great. We can get together, be face-to-face on a Zoom meeting, 15, 20 minutes, meaningful conversation. So you might say, hey, Judd, Wednesdays are the best day for me, and mid-afternoon. Great. We're going to send you an email, text, or call 1 week ahead and say, hey, Damon, are you still available next Wednesday at 2:30? And you might come back and say, hey, no, I'm going on vacation, Judd. Well, Bert, my operations manager, will say, hey, what about the following Wednesday at 2:30? So I think it's important that client and advisors are having very fluid communication. For instance, if you think one administration or the other is going to get back into the White House, my dad was a guns and gold guy. And so that's important to know, that if you think whoever gets in next time could mess up the markets or the economy, it's really important for your financial advisor to know that. We might need to make some changes.
Has your business changed in what you guys do? Because I don't talk to anybody who doesn't think taxes are going up in this country. And it's not a right-left thing. It's a math problem. So tell me a little bit about all that.
Yeah, it definitely has changed. I've been in the business for 30 years, and we've had some major tax law changes. Now you have to have a really big estate before you even need to worry about creating trust and things of that nature. So it's a lot different. And I think that, if this current administration does get in again, they promised us that taxes are going to go up. So I think we're going to have to revert back to the mean a little bit and start talking about some of those more complicated, advanced tax planning strategies.
Yeah, and let's talk about that, because when people hear the word mitigation, it's always like the buzzword. What does that really mean? Tell me what it means to you, and tell me about mitigation strategies and why they're so important.
I think most wealth advisors or planners, aren't using as many tools in their toolbox as they should. And I think anyone can do wealth management, financial planning, and I don't want to downplay that because it's very important in our industry. But when you've got, high wage earners or folks that have done really fantastic in the real estate market, you really have to come up with some creative options and strategies. And therefore, I have actually specialized in that area over the last 5 years. And some of the vehicles that we use are little known tax laws, such as, I'll start with the solo K. My wife's a real estate appraiser. She doesn't have any W-2 employees. And so in 2001, with the tax law changes, they kind of took what is a SEP IRA, the small business plan, and smushed it together with a 401k. So this year, my wife can put up to $69,000 away into a solo K. There's no administration, unlike a typical 401k, so it's very cost effective. The only codicil is that you really cannot have any W-2 employees other than yourself, the owner, or partners, or some family members, all right? But what business owners love about it, Damon, is that it has a loan provision like a 401k. So it's a great safety net, all right? So I'll start with that one's kind of simple. Some of the ones that I've been using, though, are oil and gas participation. Have you ever heard of intangible drilling costs?
I have not.
Probably not. And so despite what some people might think we're all going to be riding in electric cars and using solar power, we have always wanted our country to be energy independent. And so if you're an American citizen and you invest in oil and gas exploration and development, then you can get up to a 92% income tax deduction, all right? That's amazing for high wage earners. Also, another one that I'm just infatuated with, and we've heard a lot about it, is opportunity zones. Opportunity zones were brought around in the tax code in 2016 to encourage economic development in low-income areas. So each governor got to choose areas of their state that they could designate as opportunity zones, all right? And there's some amazing tax benefits, such as originally you could get a 10 to 15% deduction on your capital gain. Second, you've got 5 years to pay the capital gain. And then the third is that at the end of the 10th year, whatever that investment has grown to comes out 100% tax-free, all right? So let me give you a real-life case study. I bought an office kind of at the high of the market of 2007, and then actually someone bought it recently in 2020. So I bought it for about $250,000. I sold it for $600,000. And most people, Damon, would say, wow, you had a great capital gain. I did. But one of the things that people do forget about, and if you don't work with a great tax expert, you might not know this, is that you depreciate your real estate each year, your investment real estate. So I had to recapture that income as well. All right. So I had about $150,000 worth of income recapture, as well as about $350,000 worth of capital gain. So what I was able to do is take the proceeds and do a 1031 exchange, Delaware statutory trust, all right, to mitigate taxes on that. You do that with real estate only. Opportunity zones, you can take any type of capital gain, stock, collectible, real estate. So I invested in some opportunity zones in North Carolina, as well as I used oil and gas to mitigate the income. So I would have probably paid somewhere in $150,000 between the capital gains and the income in terms of that. I was able to basically just about wipe all of that out with those programs.
Yeah. Now, on a more basic level, are there other themes that our audience may not know about to either ask their tax professional or think about doing as far as investing or mitigation when it comes to taxes? Are there other investing themes that you like? I mean, you've mentioned 3 good ones already, but are there any other more basic ones for people who aren't into real estate or other things?
Yeah, and I think, again, most financial advisors, planners are going to think about, maximizing your IRA contributions, maybe putting away into a Roth IRA so that you got tax-free money in the future, maximizing your 401k. This year you can do $30,500 for folks like me who's over 50, 22.5 for those under. But where I think they're missing the mark is there are investment vehicles or funds that can help you mitigate those taxes, whether it's the 3 that we spoke about, or one of my favorite is Roth conversion strategies.
Yeah, I was just going to ask you: Are you advising people on Roth conversions as opposed to, and is there an explanation needed for some people to understand, like, do you want to pay on the seeds or do you want to pay on the harvest? Like the difference between a 401k and then a Roth. Do you do a lot of that?
Yeah, definitely. A lot of us, I think, again, I can't give tax advice. I'm not a CPA, but I think if you should be working, your advisor should be working real closely with your tax experts as well as your estate planning attorney. So, we look at a lot of folks because Roth 401k didn't really come around until probably the last 10 years. So a lot of us, especially baby boomers, et cetera, have a lot of pre-tax money. And when we take that out, Damon, that's 100% taxable. When you take money out of the IRA, the IRS says, great, now we get to get our money back.
And your general partner in that can change the terms at any time.
Absolutely. So, we've got opportunities now where we can do discounted Roth conversions. These are generally in real estate, but also oil and gas as well. So let me give you an example. You could take $100,000 of an IRA, say you've got $500,000, and you move it into a separate IRA. And these are going to be real estate developments. Some are in healthcare, also oil and gas. And because of the tax rules, they're able to go out purposefully and appraise the properties, because this is ground up development, and they devalue it. So they devalue it somewhere between 30 and 40%. All right. So now let's say that your 100,000 is worth 70 on paper, and then over a 2-year period where they're building these developments, you actually convert. All right. So instead of converting the 100,000 and paying whatever income tax bracket you're in, let's say you're in a 30% on the Fed and 5 in North Carolina for the state. So instead of paying $35,000, now we're going to pay that 35% on $70,000, and we're going to make it more palatable for you because we're going to be able to convert it over a 2-year period, right? So we'll spread that out 35.
Yeah. Are there any other personal stories of people you've worked with you can think of, that specific strategies that you thought were right, and maybe go into a little details of maybe how much they saved? Any specific things that stick out to you over your years of doing this?
Americans are not saving as much as they should. And, luckily the Secure 2.0 Act came out year before last. And they have really done things like, it used to be 70.5 that you were required to pull your money out, because Uncle Sam says, again, I want to get my money back. You put that in pre-tax or you got a deduction. And so, they're moving that up. This year it's 73. And eventually, by the time that I start after taking mine out, it'll be 75. So I think people need to do a good job. They need to start early. Some young people were here helping us get set up, and I would encourage them to put 10% of their income away each year to kind of get to where they're going. And definitely a mix of tax-free and or tax-deferred. Pre-tax money is good.
So let's talk about your industry a little bit. Are other planners using these techniques, and if not, why so?
As I mentioned on the front side, I think wealth management and financial planning are most prolific, And I think the reason that not a lot of advisors are kind of grabbing on to this tax mitigation strategy is, admittedly, these strategies are very long term. Opportunity zone, it's a 10-year holding period, right? So you just asked me, is it sometimes a strategy maybe not right for a client? We want to make sure that they've got that 10-year runway. When you invest in oil and gas, wells last about 10 to 15 years, natural gas up to 25. So when you invest that money, you need to really have your eye on the ball, because I'm in one of the highest tax brackets, and North Carolina has taxes too, not as high as New York here, but nevertheless, I got an instant return. But my money just went poof, Damon. I can't call up one of these managers or your advisor and say, hey, I need $20,000 because something happened. So it's not always right. The Roth conversion or four-year deals, etc.
When you sit down with someone for the first time, are you able to kind of go over what the strategies maybe they're missing are? Do you give them like a pro forma? Can you say, here's what we comfortably think we can do for you? Tell me a little bit about that.
It's sad, Damon, that not a lot of advisors are working closely with CPAs. CPAs are a different animal. They're generally kind of hourly. These days, we work off of fee-based. I'm a fiduciary, right? And so I'm a fee-only advisor for the most part. And I have gotten, again, real lucky to hook up with a fantastic tax expert. And he's sending me referrals because his clients are selling a property that they bought 15 years ago and making some incredible gains on it. They've got a client that's a high wage earner. So he's kind of keyed in on my expertise and what tools I have, in my toolbox. But definitely we are sitting down with the client and using a software where we can use a baseline of last year's taxes and then say, okay, what happened this year? You sold a rental property. You've got a $500,000 capital gain. Do you want to do a 1031 DST where you generally have to take the entire capital gain? Clients generally don't want to do that. So we can actually put into the software and say, okay, what happens if you put $200,000 into an opportunity zone? What happens if you put $100,000 into an oil and gas participation with a combined $200,000 in the op zone? So we can almost tell them to the penny what their taxes are going to look like. And when you show them, okay, this is without and this is with, it's a pretty easy decision for the client.
Business owners are always worried about the business and about the bottom line and about what's coming in. But do enough of them worry, and do enough of them have a tax mitigation strategy thinking for the business? And how important is it for them to have that?
Yeah, it's real important. And, there's just riding over to your building here, you see a lot of small businesses, which what really creates the GDP in this economy, the majority of it, but they're not prepared for the future. And if they've got a successful business, I'll give you an example. I've got a pool builder in our area, and it's done a fantastic job, one of the largest, and there's probably a lot of consolidation going on. Well, that business is probably going to be sold for about $30 million. She's going to have a lot of capital gains going on there. So we're going to have to talk a lot of strategy, and it's really best that you get out in front of that. So I think that, if you ask the business owner, do you want to sell? They're like, definitely. I'd like to do that. My kids aren't going to take this business over, right? Are you prepared to sell? They're not. So, you need to bring someone from the capital markets in, investment bankers, talk with them about what it's going to cost to use someone to market your business to get top dollar. But then what are we going to do to try to mitigate those taxes? Because we hope that, we're going to make you real rich.
You emphasized the importance of protecting your clients' blind sides, you said. Explain why that's so important to you.
I realized that my job is to protect my clients' blind sides, right? And even though it's tough to talk about mortality, we need to talk about, long-term care. We need to talk about disability. We need to talk about protecting their loved ones and protecting their legacy from taxes. So there's a lot of great strategies, whether it's charitable remainder trust, with a wealth replacement trust. We've done about every trick in the book that is a legal IRS way to make sure that your legacy goes to the right people, not to the IRS. And so hence I came up with my tagline, protecting your financial blind sides, back in the early 2000s after that incident.
Yeah, that's great stuff. All right, let's do the most important thing we can do. People listening out there, how do they get a hold of you? Where can they learn more information? Where do they go?
Sure. It's very rare, but on my business card is my cell phone. I actually prefer for folks to call me on that. It's 704-301-4080. You can find me on the World Wide Web at jhgfinancial.com. We're on a lot of different social media platforms, whether it's Facebook, Twitter, LinkedIn, etc. So any one of those platforms you can reach out. My email is Judson, Judson, .gee at jhgfinancial.com.
Judson Gee, thank you so much for being here. Great conversation, really important stuff. We hope that people reach out. Thanks for being on Spotlight Television.
Thanks for having me, Damon.
And I want to thank you for watching. Until next time, we'll see you right here on Spotlight Television.